we can see it. Right now we see the whole desktop. All right. Good deal. All right, everyone. Good evening. We're going to get started. Sorry we had a little technical difficulty, but that's just how it goes, how we roll. So I'm excited about tonight's topic. Because I feel it's an underutilized benefit that we have of being home business owners, and it's something that we gloss over during a presentation. Sometimes we don't even bring it up at all. And I remember Simon Chan had a webinar recently, and it was called "The Two Ways You Make Money with Your Business." And one is increasing your income, and the other is limiting your tax liability. He said, remember, it's not how much you can make, it's how much you can keep. And so I'm very excited to go through this content tonight. I just want to let everyone know, I know Matt will talk about this, but this is not tax advice or anything like that. These are our principles. Obviously, always talk to a tax attorney or an accountant or someone within that field who can give that kind of advice. Or just want to make that clear. I know Matt will reiterate that, but I just want to make sure everyone knows that. So also, before we get started, you can submit questions to me. I've got the chat box enabled. So if you have questions for Matt, you can send them to me. And if we've got time at the end, we will we'll be able to go through those and answer questions for people. So Matt, are you still there?
I'm here, my friend.
All right. Well, I get the privilege of introducing someone that I really respect and really care for. Matt Ryan is a one-star Diamond Director, Foundation Executive one-star Diamond Director. He's a $1 Million Club member, U.S. Fortune member, top USANA trainer. I'm going to let him tell his story real quick. Just, I know people on this team, we love everything Matt has to say, but, want to hear your story because I think it inspires a lot of people and lets them know what a great business this is. But I tell you what, guys, this guy, Matt, Shanna, they're family to us. So very thankful to have them in our lives. And so, Matt, if you could why don't you take us through your story for the people that really don't know, really don't know about your story?
Well, I appreciate that, Matt. And I will let you know, Shannon, I feel the exact same way. Once we got to meet your dad and realized that we had that common bond of Christ, it was pretty simple to have family members like you guys. And so we consider it a privilege and honor. And so thank you for that introduction. But I'll just share real quick. My background was in landscape contracting. And I started at the very young age, always being a hard worker and always being entrepreneurial. Started, cutting grass in high school kind of thing because it paid better than bagging groceries. And before I knew it, I had trucks and trailers and crews. And, while I was in high school, I'd be going to English class and I would have guys out, working for me during the day while I was doing that. And that was great. And it put me through college. It allowed me to buy my first home. I was able to, on that just, get married, provide a life for Shannon and I, right at the get-go. And I stuck my hand in multiple other cookie jars business-wise and just really, but was dealing with employees and with dealing with headaches and dealing with a lot of the other things that conventional business owners deal with. And I could just remember having one of those terrible, no good, very bad days where I was literally at church and with a buddy of mine who was also a business owner said, man, I just need to find something where I can make what I make, but I don't have to deal with the headaches of employees and, taxes and workman's comp and all the different things that come along with it. And he goes, man, you've got to check out this industry of network marketing. And I had a preconceived notion in my head what that meant. And so I blew him off until finally I had another terrible, no good, very bad day. And in landscaping, what that means is that sometimes people forget to come to work, or the ones that show up, they might show up a bit intoxicated, things like that. And I'm not going to get into too much detail of that part of the story, but just understand it was just one of those types of days that he said, hey, Matt, you got to look at this. And I said, man, you got an hour. And he came over that night, introduced Shannon and I to, it wasn't USANA, it was actually a different opportunity that we were excited about. And lo and behold, we didn't really know what to look for in an opportunity. And so that business actually went out of business just 6 months after I enrolled. But I learned that this industry worked. And it was a matter of finding the right company to work with. And so it was actually August 8th, 1997, when I enrolled in USANA. And, my wife at that point, she didn't want anything to do with it. She had the crash and burn experience with our prior company. And she wanted to, let's buy more trucks, buy more trailers, hire more guys, and just build, a landscaping empire. And I just didn't want to do it. I didn't want to babysit grown men. It was exhausting. It was constant headaches and all the things that go with conventional brick and mortar business. And so I started pursuing USANA. And to her credit, I was working all the time, running that, still trying to finish college, the different things going on. And so for her, it was just one more thing on my plate, when she already never saw me. And so I piddled with this. I mean, I put in 2 to 5 hours a week, consistent, doing what they had taught me to do and focused on that. And within about a year's time, we'd replaced her full-time income. Another year after that, we'd replaced my income in landscaping. And so I was selling that company. And so that will be 20 years this coming August that I've been involved in USANA, and full-time. Actually sold my landscaping company February 11th, the year 2000. So that'd be 17 years and a bunch of months that this has been my full-time livelihood. And I love it. I get to be a stay-at-home dad. I get to take my kids to school. On the way home from school today, I was picking up my son. We actually had this whole conversation about sacrifice and, delayed gratification and what that, looks like. And, he asked me if I thought about him during the decisions I make. I said, Will, I was thinking about you before you were born because I was working so hard, focusing on the life that I want to provide for you. So I could be here now to pick you up and take you home from school because of sacrifices that we did before. And I could tell that there was a few things that just started clicking with him. And so one of the things with me is that business has always made sense. Numbers has always made sense. And so a thing that I've implemented within some of my team members and some other coaching stuff that I do is just what I call financial fitness. And one aspect of that is keeping more of your money. And so we're going to talk about taxes tonight. And so that's my story, long and short. It's excuse me. Yes, we're part of the $1 Million Club. In fact, we're crossing the $4 million mark as we speak. And it just seems so crazy that's the reality, but it is what it is. And so, and it's for anybody to do that wants to pursue that. But let's talk about taxes, because as Ben Franklin's already told us, there's one thing that we can be certain of, and that's death, and that's taxes. And so we're not going to escape either one of those. So if we've got to deal with them, let's deal with them. And so let's talk about taxes. And there's a lot of beliefs about taxes that people have, and I will try to pace myself. I know that the slides are changing a little bit slower than my voice. And so I apologize for that, but just bear with me. But some of the beliefs that people have about taxes are simple. It's like, well, if you make too much money, then you got to pay too much. I've literally had people in this business not enroll because they sit there and they were telling me, but if my income goes up, I'll have to pay more in taxes. And I think that's one of the most asinine statements you could possibly make. And I'll put it to you in this way. If I'm going to write you a check for $10,000, but you got to mail some of that off to the IRS, do you still want me to write you a check or not? And the obvious logical answer was, of course I do. Exactly. And people get this big fear about taxes. They think it's some big, misnomer or some big evil. But if I write up a home office, then I'm going to get audited. But if I take a deduction, then I'm going to get audited. Bullcorn. That's not how that works. One of the dumbest things that I see people do is they get all excited because they get a big tax return. Let me tell you, the worst thing you can possibly do is get a big tax return. You need to figure out how to pay about what you're going to owe, period. Because here's what a tax return basically is that you lent the federal government money at 0% interest. Think about that for a second. What could you do in your monthly cash flow when people tell me, I got a $4,500 tax return, I got a $5,000 tax return? What could you do if you had that extra $400 and something per month in your cash flow working for you, doing something to help build your wealth rather than just lending it to the government for free? And so we got to kind of change our mindset when we think about taxes. Yes, we got to pay them, but we don't need to pay any more than we have to. And here are some very basic things that I want to walk through so that you kind of understand is that as an employee, this figure on the left, as an employee, your taxes are pulled before you ever touch your money. So what happens is that you get your check, and that check from your employer, they've already deducted a bunch of taxes from that are being paid to the government, and the employer has to match it. They have to do all these kind of things, your federal and everything else. and you're left to pay your expenses on that amount that it's left over. What a business owner does, any business owner, they pay their expenses first, and then they pay tax on the amount that's left over. So even if your income doesn't change a dime in USANA, but you're able to expense things that you're already using, like internet access, etc., 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 you're paying you're paying your income tax on the lower number after you paid the expenses. And so here's what that can look like as we start moving forward. Excuse me, that's actually going to be the next slide. So remember, it's just not how much you earn, but how much you actually can keep. We know that most households have got both spouses working today. That's just the way it is. We want to capitalize on this for the purpose of increasing and making wealth. It's not just, sometimes people will say, well, gosh, I may never be a gold director. I may never be a ruby director. Someone thinks on it. You know what? That doesn't really matter. You can build wealth by getting that business of yours to where it's at $200, $400, whatever a week consistently, a good, solid, basic business like that. And you can build some serious wealth if you do a few smart things with your money. And this is one aspect of that I'm going to talk about tonight. So let's talk about this. For 2016, this is the tax brackets. And I'll give you a couple of seconds to kind of look on there and you can figure out where you are. So if you're single filing, that's the far left column there. If you're married filing jointly, which is typically what most households participate in, that's that second column there. And what we know is that the average income of a single person in the U.S., average U.S. per person household income is $43,460 a year. If both households are working, we double that, roughly about $85,000 a year. Is an income for an average U.S. household. And I get it. We've got different markets on the line. We've got different costs of living in different places. But if we're just going to talk averages, this is the average wages that someone in a career or job makes, as they're getting, established and developed. Some of you looking at that and goes, oh my gosh, I make way more than that. Great. Many of you probably do. Some of you may be looking at that and goes, oh my gosh, I would love to make that much money. And you know what? There's a process and a thing that we can do. But the reality is that all of those people within those averages, the government knows the averages, fall in this 25% tax bracket. Most of them fall in that 25% tax bracket. So let me translate that in simple terms for you. For every dollar of your paycheck that you have, it costs you 25 cents for that. For every dollar of your paycheck that you had, it cost you 25 cents. Let that sink in for a second. Sure, it's a quarter, maybe it's chump change, but that's a ton of money. What business owners get to do, this is what this means, is that if you're a single person at the 25% tax bracket, and I understand there's a basic deduction, standard deduction, and you can write off some healthcare things or some basic things, but as just a simple rule of thumb, a single person is going to pay roughly $10,000 a year in tax. A household married couple is going to pay a little over $21,000 a year in tax. Stinks, doesn't it? So what that means is that a married couple in this situation would be living off of about $65,000 a year when they're really making almost 90. That's pretty sad. Sandy Botkin explains in his book, Lower Your Taxes Big Time. He actually has an updated version of this that's available now. But chapter 1 of his book is why you would have to be brain dead if you don't have a home-based business. Why you would have to be brain dead if you don't have a home-based business. I don't care what it is. Network marketing is the one that fills the biggest gap. It's the one that covers those 156 tax deductions. When I had my landscaping company, when I had a jet ski rental business, when I had a motorhome rental business, I still have rent houses. When I had other things in my hands and other cookie jars, I thought I had all the tax deductions that there were. I was wrong. I could expense and write off things that were in relation to my business, but it didn't cover the aspect and the large spans that network marketing does. Because within network marketing, everything that I do can be some form of marketing. Everything that I do could be in the process to generate a lead or to generate a customer or to generate a client. With USANA and doing business with this in many countries as we do, it creates a situation that we're actually able to make travel. We're able to make recruiting and things like that when we're in other parts of the world that we do or do not have business. As long as we're open for business there, those things can become deductible. Let's just talk about the basics expenses that everybody has, whether you're doing USANA or not. You have a phone, you have Wi-Fi, you have office supplies. Even if you don't have a home office, you've got kids and you buy crayons, pencils, Post-its. My children have school supplies that I have to get. They don't take school supplies to school. They take office supplies to school. You have travel, you have meals, you have entertainment, gas, all the different things that are associated with those. All of us have these expenses that we're paying money out for. The thing is that we're paying that money out on 75 cents of every dollar versus having the full dollar. So think about it. Let's use travel, for example. If you were to go on a trip that cost you $1,000, in reality, it cost you $1,250. As a business owner, if you go on a trip that costs you $1,000, it costs you $1,000 because you're not paying the income tax on that money. Here's a real simple example that I use with just some of those expenses. And I actually have given Matt a copy of the spreadsheet so you can play with it. You can change some of the numbers around and stuff like that. But, cell phone, internet, office equipment, these are all things that all households have. And I just plugged in some basic average numbers, assuming some basic internet cost, cell phone cost. And I get it. Many of you have 2 and 3 cell phones in your household. And I get it that there are other things that can jump up. And then the home office deduction. And so I even give you the formula, and it's already done there for rent. So in other words, if you put in your rent, utilities, your insurance, some maintenance costs and everything like that, and what that total household expense is, then you figure the square footage. You figure the square footage of the facility that you've got. I'm just going to kind of circle this for you. I'm going to try to circle this for you, so you can kind of see where I'm talking. But if you're looking at that, you can see that there was $1,500 of expense. This is just an example, by the way. And if you had an office that was 162 square feet, you would see that that's 15%. So 15% of that 1,500, that's where we plugged in this number 225 all across the board to come up with that number. Don't be afraid of that number. So that's the same thing for if you owned a home. So if you have landscaping, that would go in there, a percentage of that. If you have your water bill, utilities, if you have a security guard, that's your security system for your business. All those things can go in there as a percentage that you can deduct, off your taxes. You're paying those bills anyway. Not only that, let's talk about car mileage. Car mileage is huge. As a USANA associate, when you leave your home, you were out to build business. If you talk to someone at work, you were driving to go talk to that person at work. You just happened to do your job while you were there. If you were going to lunch with somebody, there could be a waitress, a waiter. Mileage is a huge deduction you can take advantage of. And so I want to show you this real quick. Let's just say that you decided to drive to convention, and it was 2,600 miles. Sorry, my finger and my mouse are not getting along. 2,600 and something miles. That's a $1,500 deduction. $1,428 deduction just for driving back and forth to convention. You might even be able to make money driving to convention. Think about it. Meals and entertainment, that's a huge one. We have 2 categories. We have meals and entertainment, yes, but we also have presentation expenses that we use. Presentation expenses are 100% deductible. If I'm doing a presentation and it's at a restaurant, 100% of that bill is deductible. So let's just total this up. This is just average. This is just life. And if you're not doing presentations, maybe you go out with your spouse once a month or something like that, and you call it an executive board meeting. Well, that's my wife and I have executive board meetings all the time. Those are deductible. That's about $9,200 total expenses just totaling this up. Okay. If I move forward and look at that, if you're a single person and those were your basic expenses, that means that I lowered your taxable income by $9,200, which means that basically on paper, as far as the IRS is concerned, you only made $34,000. In the prior example, you were in the 25% tax bracket, but with this example, you're now in the 15% tax bracket. Let me explain something. Nothing has changed. You've kept every single dime of your money. The difference is how much you're actually paying in tax. So instead of paying the over $10,000 expenses, almost $10,000 expenses that you were paying before, sorry, I lost my pen. The $10,000 expenses that you were paying before, now you're only paying $5,100. You're keeping almost an extra $6,000 in this simple example. And we're not even talking about the regular business expenses. I'm talking about just the normal expenses that you have in a household. How about a married couple? Okay, prior you were making about $83,000, paying around $20,000 a year in taxes. If we deducted those same expenses like we did a second ago, now we're at $73,000 of income. But again, as a married couple, that puts you in the 15% tax bracket. So instead of beforehand paying $20,000 in taxes, now you're only paying $11,000. You're keeping you're keeping $800 more a month. What can you do with $800 a month? And this is not even getting nitty gritty. I highly recommend that you pay someone to do your taxes, which is also a tax deduction. And let me tell you why. You pay professionals for their expertise. You need to find somebody who's familiar with home-based business. Find somebody that you can pay. It just depends on how complicated your return is. But you need to plan on spending $500-$600 on your tax return as a minimum, depending on who it is, because you pay for expertise. I will tell you, it won't cost you a dime, because they're going to find you more benefit than what they actually cost you. It will make you money. Do that. In this example here, you're keeping almost an extra $10,000 a year. So if we go back to this example, remember, as the employee, you're paying all the expenses first. As an employee, you're paying your taxes first. As a business owner, you're paying all those expenses first. And so you're only paying the tax on the leftover amount of dollars. Your income hasn't changed. Your value hasn't changed. It hasn't hurt your credit. It hasn't damaged anything else. All that's happened is on paper, you're making less money. But here's what's happening in reality. You're keeping more money. And I don't know about you, but my focus in building businesses and in working with USANA stuff was about building wealth. And if I can keep more of my money, I'm going to build more wealth. Scripture says a wise man leaves an inheritance to his children's children. I don't know if you put together a game plan to be able to leave an inheritance to your children's children. You can do more. You can help more. You can give more. There's more that you can do with more cash flow. You could pay off debt. You could live on straight cash. You can be one of those weird people that wants to have a 0 credit score because you don't have to borrow money ever. And it's not that you went out and went 1-star or 3-star or 5-star. It's that you just were a little bit smarter about what you're doing with your cash flow and then what you're doing with those dollars. What if we added some extra business expenses? Here's just some regular business expenses that if you're actually pursuing an income that you could easily justify, and have, like marketing materials, advertising, personal growth, training events, traveling to convention, doing things like that, other travel that you may have. It's very easy to come up with another $4,500 dollars of expenses that you could have very simply if you're just pursuing an income, for USANA. So if you added that in there too, that's also less money that you're paying in taxes. Bottom line is with USANA business, specifically USANA, because we're in network marketing and because how this works, we're able to keep more of what we've got. We're able to expense things that we're already paying for and taking advantage of those additional tax breaks that you don't necessarily have through your conventional business. It helps you lower that tax liability. It puts you in a lower tax bracket. This is a good thing. Don't think it's a bad thing. It's a good thing. Okay. You're ultimately getting to keep more of your money, and it's ultimately going to help allow you to build some wealth. So Matt, I looked at my clock. I'm sorry. I kind of got on speed dial there at the end. If there are questions, I'll gladly, I can go back some slides, or I'll gladly do whatever, whatever it is you guys need me to do as time allows.
All right, no, go ahead and keep going. Just got a couple questions, but it was really more generalities. Okay. So yeah, definitely keep going. You're doing an awesome job.
Well, I was just summing up these last ones really quick when I looked over at the clock. So I can put these back up here. I can flip back to any slide that anybody wants me to.
Yeah, could you go? We had a little delay when you were talking about the how much the single person can keep. It was we got that delay with everything with Webinar Jam.
Yeah.
Let's see. Just so people can see that, and if you want to, really, if you could even, you know what? Yeah, either the married or the single person one. Can you just walk through? Go ahead. I'm sorry.
Is this a slide you want?
Yeah, let's stick with this one. The write off. It says right off the basics, and so married. So can you talk again? Because again, there was that delay. where you're getting, the average married person, we understand, okay, they make 83,000 a year, they get taxed, that puts them at 25%, so they get taxed 20,750. Where are you getting just that was one of the questions that just came in about the 73,727. Where did that come
Calculator.
from? So that was so because of
25% of 83,000.
that was because of the expenses that it bumped down.
So is yours on a single person now, or is yours on married couple? Because my screen is now
married couple.
Okay, I'm going to move back to the married. Okay, I'm on married. So 83,000 at 25% is where I came up with the 20,750.
All right. So so I think I just got a couple people right in that it makes sense. So where they got the 73,000, so that was because of the expenses. So those were deducted. Those are or expenses rather. So then it put them at that 15% tax bracket.
So no, I made a math error. Good catch. So actually, no, I'm sorry. Where the 73,000 comes from is when I deducted the roughly $10,000 in expenses that I showed you from cell phone, et cetera, et cetera, et cetera.
Right. That's what I was referring to. So
yeah, so that's where the 73,000 came from. I'm sorry, I thought I'd made an error. No, we're good. And so then that at 15% would mean you'd only be paying the $11,000 in taxes versus 20.
Love it. So because it bumped you down a tax bracket, like you said, then instead of paying 20,000 in taxes, it's actually around 11,000. So you keep that much more. And so it's like we said, it's not what you can make, it's what you can keep.
Right. Their cash flow, even if their jobs are exactly the same, no raises, no thing. And this is also taking out, I get it, there's some standard deductions and there's some other things like that. And some people have 401k drafts and other little things, but just on straight math, they're actually keeping more of their money. So technically increase their cash flow just under $800 a month.
I love it. That's fantastic. So one of the questions that we got was actually from your story. And you talked about that 2 to 5 hours a week. And I think a lot of people have a hard time believing that if you're consistent for 2 to 5 hours a week, you can really build something. So could you talk about that real quick on just what you were doing for those 2 to 5 hours and really how this business can be built on just those couple of hours a week? Because, people, they have a hard time with the, I want to go all out with this business, but they go, well, really, 3, 4, 5 hours a week really can be giving 100%. So could you talk about that?
Yeah. So what that looked like for me when I first started, we didn't have like today where you can shoot a text message and someone can go watch a couple videos, or you can send a quick, whatever on the phone where someone can look at some information, instantaneously. What we had then is you literally would be dropping off a VHS tape or a cassette tape that someone could listen to on their way home, or that someone would be watching later. So, at that time, being in landscaping, I literally lived in my truck. And so I just learned that, the more VHS tapes and the more cassette tapes that I could have in circulation doing presentations for me, the faster my business would grow. So what that 2 to 5 hours a week would probably look like would be, I'm meeting with a regular client in landscaping, and around the corner, I've got a buddy, and I've already made the phone call, and I'm going to be dropping that off and encouraging that he's going to watch that tonight, so that I can get it back tomorrow, because I got people waiting on it, because I have a limited number of things. I'm going to call him back tomorrow night or even later this evening, after he's watched that 30-minute overview. And I would have someone on the phone that could be answering my questions. So I would be circulating so much material that when I was doing follow-ups and had such little time to do it, it created an urgency, because people could tell I was excited. They knew I was busy. They knew I didn't have time to mess around and waste. And so they knew that if I was spending time doing something like this, it had to be something worth my time. It had to be worthwhile. And so when we would do follow-ups, I was using my expert person, my upline. So, just like using Matt, to help do a follow-up and answer those questions. And we would just ask 2 or 3 quick qualifying questions to know if we need to spend a lot of time with them, or if it's just not the right time and we'll get back with them later. And so, after reviewing the information, we would just ask real quick. So listen, what did you like best about what you saw? I still do this. What do you like best about what you saw? They're going to tell me. And I would just say, just real quick, what's your interest level on a scale of 1 to 10? 10 being I don't want anything to do with it, or excuse me, 10 I'm ready to get going, and 1 I don't want anything to do with it. And so if they were a 7 or better, then I want to figure out what we need to do to get them to a 10. If they were a 2, 3, or 4, I wasn't going to try to convince a 2, 3, or 4 to be a 10 because it's not the right time for them now. And I would just say, well, was it, is this something that you'd want to pursue? No, I'm kind of like a 2. Okay. Are you interested in the products? Not really. Awesome. I'm going to get the information back. I got people waiting on it. And that actually created the buzz that when I would get back with those same people 90 days later, because I kept a list. It wasn't as high tech as the names list that people do today. Mine was on a legal pad, but I would just mark on there that I'm going to, get back with them, or I'd make an index card and I would just stick it kind of in a tickler file that I'm going to get, here we are the end of April. So then, hey, end of July, I'm going to be getting with them. And I would make sure that it was okay. Hey, can I get back with you the end of July and just let you know how I'm doing? And so when I would be getting back with them, they're like, so seriously, you're still doing this? Yeah. And so by that point, they would probably be more like a 6, 7, or 8 than they were a 2, because 1, I'm still doing it. 3, they can tell I'm excited. And I've also got more documentation under my belt. So that's pretty much what that looked like.
I mean,
I was a passing out freak.
I think it's fantastic where you talked about all it was getting information to people, doing follow-up calls, and that's it. And that consistency is key. I think we do it for 1 week and then take 3 weeks off, and do it for 1 week and 3 weeks off. And then we go, wow, I've been in USANA 2 months. It's like, no, you were in, but not building. So it's it was that consistency and really getting your upline on the phone, doing follow-up calls, and going from there. And that follow-up, I think, is such an underrated concept where, like you said, people are testing you at first. And is this person going to stay with it? And I don't know. And then, 90 days later or 6 months later, you're still building the business. And they go, wow, you're still doing this. Oh, well, yeah, wow, I can do this. Let's do this. So yeah, follow-up is great. Just so everyone knows, Matt had a special gift for us, and we're so thankful. That Excel doc that he was referring to is posted here. You can download it. That was a great gift from Matt, so we're so thankful they gave it to us. One of the last questions here, I guess we can kind of end with this, and love to just any last tips you have for us. The $200 to $400 a week range. Talk about that. That really $1,000 a month. Why, in your opinion, is that such an important thing? Because I think, a lot of times people, and you said it earlier, if I don't go gold, then then I feel like I failed, but really having that solid $1,000 a month, what does that mean for people if they save it and utilize it right? And how does that change lives?
Well, it's 2 things. So, I mean, a part-time business, that's making, that's making $1,000 a month, you got enough skin in the game that it's worth your attention. Right? So that person is, one, they're going to stay engaged. So therefore they're going to at least be maintaining that and move forward, which obviously is good for, a sponsor and upline if they've got people that are, making that kind of income. But why I see that as such a magic number for building wealth is because, if you just take your budget and I don't mean to talk in generalities, but I have to. I mean, I'm talking about basics on this whole thing and averages, but unfortunately most households live beyond their means. They live beyond their means. And so as their USANA income and stuff like that may go up, what they typically end up doing is increasing lifestyle. What I have a tendency to preach more, and I know it's not very popular, so you can hate me or slap me afterwards. If you'll live below your means and you'll really take that other $1,000 and you start killing all your credit cards and you start killing, other debt. I mean, I'm talking your house. I'm talking the whole shoot and shebang, and what that will do for your overall monthly cash flow. I mean, you'll be crazy weird, but I mean, I'm telling you, it will absolutely change your life. I mean, try it for a year. Take everything you make off USANA and focus on that, and go pay off college. Think about it, or if you're in the situation that you don't have, that's not your situation. Maybe you're younger and getting started. Take that money before your income gets too big and go open a Roth IRA. and just pull up a more pull up a time value of money calculator online. They're all over the place. You can pull them up and just look at what $1,000 a month, um, which you can do 5,500 per person if you're a married couple. 5,500 obviously as single in a Roth IRA, and there are income restrictions once you're at a certain point. But basically, what that means is all that money will grow tax free. So if you've got 20 or 30 years that you could be putting in $1,000 a month, you're a millionaire. And it's not just that. Look at the tax savings just in this example alone. If you were earning an extra $1,000 a month, plus the other $807 here just in the tax deductions that you've got, that's a $20,000 swing.
I like the way you just phrased that. It's a swing. That's really what it is. It wasn't just growth. It was swinging from one way to the other. And so, yeah, you're right. Yeah, I think a lot of people, we see these examples, and people, whether it's USANA, other things, whatever, you've got to have lots of money coming in. They can do all these great things. And it's like, no, if you're smart with money, let it compound, save it up.
Yes.
Have fun in life, of course, but save it up, bank it up, and really have that long-term vision. I think a lot of people don't understand money because they're afraid to learn about it. Instead, it's like, no, don't spend so much time learning what's going on in Desperate Housewives. Spend some time learning about money. And
it doesn't matter who got voted off the island, right?
Exactly, because they don't impact your bank account. So, no, that was really great. It's always great to hear it from someone else who's been successful in the business to say, you know what, that 200 to 400 a week and 1,000 a month is just great if you let it grow, let it compound, and like you said, you're a millionaire. So that is great. So Matt, are there any? We're getting a lot of everyone saying thank you, they love it, all that stuff for the giveaway. We're so thankful for that. As we bring things to a close, any last thoughts you want to end things with here?
I'll just tell you, it's worth it. It just is. I actually pulled up a mortgage calculator here real quick that I just will share with you, real fast. If you'll take, I'm just entering the age. If you start at age 30 and you go till retirement, and you were making that $1,000 a month, and you contributed just the tax savings that I'm here, so I'm just doing an average of $1,500 a month that you put, and if you got an annual return. The market has averaged 9 to 11% since its inception. So let's just go with 8% and be conservative. Is that fair? Compounded continually, it's just under $4 million.
Oh, that's a number. That's a head-turning number. And it's not being like everyone else in this microwave society, but have some vision. Let that grow, and will you regret saving that $1,000 a month? Like you said, it will be worth it. So, Matt, that is fantastic. Thank you so much. Just so everyone knows, I know a lot of you knew we were in San Antonio with the U.S. celebration and different things with there, the High Performance Summit. Matt was part of that special invite. Matt really had a lot of great ideas and so many awesome things going forward with USANA. Matt, we're part of those exclusive meetings. He's been around us for a long time. He's so knowledgeable, loves USANA, and just adds so much value. So just so everyone knows, that who is on this webinar, someone who knows what they're talking about, as you saw. So we definitely need to have Matt on some more things in the future here. So Matt, I'm gonna let you go. I know it's family time and getting late there. So we really, really appreciate you spending this time with us this evening. It really means a lot.
Hey, thanks so much for having me out. You guys have a fantastic week.
Thank you. All right, USANA family, that has been your Monday night webinar. We will see you at the top. Make it a great night, everybody.